This time of year, in terms of the last 6 weeks, really from Black Friday forward, if you want to think of it as that, we go into one part window dressing and one part tax loss harvesting. And the way to think about that is find the uptrend, buy the dip, and avoid downtrends. The sector rotation is not a factor for the end of year. It is, however, a potential factor for Q1 of next. So strength gets stronger, weakness gets weaker. And the window dressing aspect of this is focusing on where the strength is. And this is a really good look at those names that are above the zero line. This is zero right here, zero line on this normalized performance graph. Now, obviously, KRE is the strongest, followed by consumer discretionary. I'm going to still kind of leave oil and gas explorers, energy, and oil services. I'm going to leave those off the list. When we get into the premium video, I'll give you all the specific symbols that are on my watch list for buy the dip, things that we've been setting up for the better part of weeks now. So we'll get into that. Another thing that we just got into today was playing the insurance, KIE, thanks to one of our members in the Sector Secrets Mastery. We want to keep an eye on JETS, which overlaps really nicely with the IYT, right? That's another one to keep an eye on. Metals and mining, we have exposure to that. Communications, technology, industrials. But as you go further down the list, you can see these are all up a little bit less. So again, if strength gets stronger, we want to continue to focus on the upside of these sectors. And we do not want to look for upside in sort of the flat sectors, semiconductors, real estate, staples, utilities. Take a look at home builders there, basic materials, healthcare, and gold miners, right? There might be individual names in some of those sectors that are outperformers. For example, in semiconductors, I really like NVIDIA and Intel. Right? In XLP, I really like Walmart. But if there is an individual stock that's outperforming in a sector and the overall sector is down, think about how much harder that stock has to work. I'm going to dive into XLY here because this one's a pretty cool sector. It's got two stocks that are definitely worth watching. I'm going to move this 5-minute chart aside. One is Tesla and the other is Amazon. And one of the cool things about the consumer discretionary ETF is rather than necessarily buying both Tesla and Amazon separately, which is a little bit more cash demanding, right, in terms of money in your account, one thing you can do, depending on the strike, is focus on XLY. Not only is it a outperforming sector, but two of the heavily weighted stocks within it are outperforming. And if you're looking at 210s, 215s in XLY December 20, you're going to have good open interest. There's plenty of open interest, and you're going to get more bang for your buck. So when you think about ETFs and that sector strength, oftentimes think, what am I taking advantage of in the XLY? Well, I mentioned Amazon and Tesla. Another one of those sectors that's on this list is communications. Google, Electronic Arts, Charter, T-Mobile, Disney, Netflix. These are all trends moving to the upside in this group. Now, in the case of XLY, we have good open interest. Do we have good open interest in the case of XLC? And I want to make sure I contrast XLY to XLC because I don't want anyone out there thinking, oh, great, I'll always just buy the ETF. Sometimes the ETF is not participating as well, and sometimes the ETF just straight up has illiquidity, not enough open interest, and that's the case with XLC. But what are some of the best names in this group? Disney is definitely one that's not only affordable, it's low cost enough that a lot of traders can get in with a small number of contracts if they have a small account, or it's liquid enough for those traders who have a large account. And it's been definitely a little flat after the rally with the earnings, but we definitely want to look at the long side there. What do we not want to look at the long side of? I'm not interested in Meta, not interested in Verizon, not really interested in Comcast either. There are other better names that have the probability of follow through. And if we can focus on that follow through in these sectors, knowing that strength gets stronger and weakness gets weaker, right? We want to serve that over an uptrend. And that's where, if we want to step back and take a look at the S&P, NASDAQ, and the Dow, this is where, it kind of comes full circle from that video that I did last Friday before the weekend. Dips happen, right? Let's not let weakness, especially one, as I explained in that video, dips happen, that was largely due to the fact that Jerome Powell did a little bit of a messaging course correction for expectations on the December 18 rate cuts. It's not as if we're not potentially going to get them, but the probability dropped 20%. But it's still the higher probability outcome when compared to a hold. So I'm going to stick with that. And you can see, if we're going to start looking at any sell-off as the beginning of a crash, or any sell-off as the beginning of some kind of further move to the downside, well, that's just not been a productive way to trade most of the year. And right now, going into the last 6 weeks of the year, it's no different. Let's stick with the bullish side of things, find the uptrends, and then find the dips, get in the dips, and then look for the follow-through. Maybe not with the expectation, however, necessarily of higher highs. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.